Good afternoon. Welcome to Money Tips. This is Charles Kelly, bringing you money tips to help you save, earn, invest, accumulate, and enjoy more money. I'm also the author of the book Borrow and Grow Rich, which shows you how to use good debt and how the rich have always used good debt to become wealthy using other people's money. Now, today I want to talk to you about property and ask the question, has the property market crash that everyone's predicting, has it already started in America? Now, I particularly want to look at the US market. First of all, I know that I mainly talk about the UK, but in America, if things happen in America, they tend to be followed by the rest of the world. The old saying, when America sneezes, the rest of the world catches a cold. Perhaps something similar could be said for China. When China sneezes, the rest of the world catches a virus. Just a little joke there. But the property market in America has, of course, boomed in the last couple of years, as it has in most places. And it's starting to show signs of a slowdown. The number of sales are slowing down. The number of weeks it takes to get a property through all of the initial legal procedures is taking longer from going onto the market to actually selling. So things are definitely slowing down. Lending is definitely slowing down. I think one of the banks, Wells Fargo or Bank of America, has laid off hundreds of staff because they're not getting the same levels of lending. And in America, they don't mess around. If things slow down, right, you're out. Clear your desk and goodbye. So that's what's happening there. Now, whether this is going to be reflected in the rest of the world, I don't know. What I do know is that prices around the world are definitely overinflated in the major cities. If you look at London, Sydney, Auckland, Toronto, Vancouver, and China, we don't know exactly what's happening in China because we can't look at all the figures. But most people are reporting that Chinese property market is about to collapse. We've already had a couple of property companies, major ones like Evergrande, defaulting on their bond payments. They haven't collapsed yet, but things are not looking good for the overdeveloped, overbuilt Chinese property market. So we know that things are overpriced, and I'm sure that a correction is probably due. But will that necessarily be any harm? Well, of course, it will be a harm if you're in the property market to buy and flip, or buy off-plan properties, put down a deposit, and then hope that by the time you have to complete, it will be worth a lot more, and you can just sell on the contract to somebody else for a nice little profit for virtually doing nothing. But if you can get stuck with that situation if you reach the end of the build period, let's say a year's time, and the market is slowed down and those properties are not selling. I remember seeing in previous recessions whole developments kind of almost mothballed, just nothing happening with them, and then people coming in and buying the developments off the builders at a knockdown price and then knocking them out to other buyers. So I've seen that situation happen before in the 90s and perhaps to a lesser extent in the last slowdown in financial crash in 2008. But that is one thing to watch. But if the market slows down for everybody else, is that a big problem? Certainly for first-time buyers, they might be glad to see prices come down and the market settle down, and it might not be a bad thing. But for investors, it might be, well, I don't know. But I mean, if you're a buy-to-let investor, then it doesn't really matter if prices are going up or down, as long as you're getting your long-term rent. And if you've got long-term tenants in there, does it really matter if prices are going this way or that way? Eventually, they always drift upwards anyway. They have done for hundreds, if not thousands of years, because the demand is there. People always need somewhere to live. There's not enough properties being built certainly in the UK. They need hundreds of thousands of properties. Population is growing. We're seeing a lot of migration into the West from the Middle East and Africa, and therefore we're going to see a more of a demand for property. And the Western countries need labour. They need skilled labour, but they need other labour because their birth rates are lower. So some think tanks are saying, well, we believe that immigration will be necessary to keep the economies going in places like Europe. Now, property slowdowns often follow a stock market slowdown. This has been common in the past. I've seen it many times. stock markets go down, like the 87 crash. And, about a year later, I remember about 88, that properties just slumped. It just went into a slump that then took, I'd say, into the mid-90s before things recovered. And many experts were saying that the market wouldn't recover for 20 years. And there was panorama programs on BBC and saying the market's finished, and look at these massive estates that are in Bristol that haven't been occupied yet. They're like ghost towns. The property market is going to take 20 years to recover. One of the lenders, the Alliance Leicester, would not lend on anything in the Docklands, London Docklands, which is a super success now. They said it wasn't suitable security. These were properties by the River Thames in the Docklands, a few miles outside of central London, where a major development was being built for offices, and big towers going up there with HSBC taking over, and even the developer for the office building, which the name has escaped me now, but it's the main office building it's Canary Wharf, I think. The major developer, the Reitman brothers from Canada, went bust, and they had to be rescued, and it was a government initiative to build the Docklands, but things went wrong at that point, and it looked like it was all going to end in disaster. But of course, now you go there, I mean, it's like an American city there. When you go there, it's just amazing what's gone on there, and all the financial institutions that are also there, and properties, of course, are worth a fortune there. So when properties go down, that's the time, as Warren Buffett said, be greedy when people are fearful, and be fearful when people are greedy. So that would be obviously the time to swoop in and buy. However, at that time, I wanted to buy property, but the banks were very tight at that point, and you couldn't really get hold of money as easy as you could in a boom time, because banks love to lend money during the boom time. But when things slow down and when things are in a slump and prices are at a record low, they don't want to lend. Now, other agents have told me that things have slowed down, and that even valuers are downvaluing properties deliberately, perhaps told by lenders to be very cautious on the valuations, because maybe lenders are fearful that things are a bit overpriced and they could go down. So, these are all things to look out for, and just be careful if you're buying to invest, if you're buying to flip, if you're buying to develop. I would say just be careful. The other thing to look at is the affordability. This is the affordability of the person with the average salary in the street trying to buy the average property. Now, of course, in the UK, as in America, there is an average figure for a property, but in reality, each city is different. I mean, London is hugely different from places up north where you can buy properties for 50,000, and in London, a starter flat would be £400,000 to £500,000 in parts of zone 1 and 2 at least. To talk about average prices is a bit difficult, but the average salary in the UK, we know in 2021 was just over 31,772. That's based on the highest and the lowest, of course, but most people would expect to earn 25 to 30,000. But if you're working in Starbucks on a minimum wage, your salary might be less than 20,000, even if you do a bit of overtime. And nurses, I think, would start at under 30,000 anyway. The average salary is all very well talking about. But let's go on the average salary for the moment. And what's the average UK house price in the UK? Well, it varies with different surveys, but according to one survey in March 2022, the average house price was around £278,000. And of course, that wouldn't buy you anything in London very much, maybe a studio, but that's the average price. So all you've got to do then is divide the average salary into the average price. So you get the average price, 278, divided by 31,772, and what do you get? You get a figure of 8.75 times the average salary needed to buy just the average property in the UK. 8.75. Now, in London, where prices are higher, it's even worse, because you're probably looking at 12 or 13 times the average salary just to buy an average property in London. And in cities like St Albans, which is just outside London, and Winchester, the average affordability for that area is something like 14 and 15 times. So, in other words, how can people continue to keep paying these prices? Well, the answer is they've either got a property to sell and they've made money from that, or if they're a first-time buyer, they've got help from the old bank of mum and dad, because parents and grandparents can easily get a loan against their property called a lifetime mortgage, and then they can give that to their children and grandchildren to go out and buy a property. It makes sense, actually, because if they're going to leave them money in their will anyway, why not give it to them now when they can use it? And then it reduces inheritance tax if they live for a longer period. It reduces the value of their estate, and they don't have to pay any payments on that loan, and it's just paid off when they die or when they sell the property. So that is a lot. I mean, when I first bought, I'm sure you could buy a property for, and my salary was quite low, and I was able to buy, well, there were two of us actually, but we were able to buy something on modest salaries, in the suburbs of London, which we just wouldn't be able to do now. Even some teachers, nurses and key workers are not able to buy at the moment because the prices have outstripped salaries. So that's a big problem for the market. So something has to give. And in some countries like China, it's even worse. And I'm sure it's a similar story in Sydney, Auckland, Vancouver, Toronto, and many parts of America. Certainly in places like California and that sort of thing, and New York. So something has to give. Also, you've got inflation at over 8% in the Eurozone now. And this is serious. Germany's got inflation at 8%. Germany's petrified of inflation because of what happened in the 1920s. They hate inflation. So interest rates are going to go up. That's going to affect affordability. That's going to affect how much people can borrow. And that's going to affect prices, because if people can't borrow enough to buy these properties, because of course we've had record low interest rates, and that's enabled people to get huge mortgages and pay these inflated prices. But if they can't do that, prices are going to have to come down. That's the market, right? That is how the markets work. So we are going to see something. And higher rates also could crash the economy. Many people are predicting that higher rates in America and the tightening of the monetary policy in America, the tightening of spending in America and Europe and Britain is going to maybe not crash the economy, but it's certainly going to put us into recession, and maybe even the doomsayers will say depression, long-term recession, really bad times, companies going bust and that sort of thing, and even countries defaulting. That could happen. We just don't know. It depends on what the governments and the central banks do. So how will the UK market react? Well, if you're in a good area. In fact, I was with an auctioneer today, and we were talking about this, and he said, look, in the past, prices have come down, but in good areas, usually prices have not really been affected in good areas, like good solid areas. Now, in those sort of areas, if you buy, you're not going to make a massive killing because they're what's called a mature area. The prices have matured. They're not like buying in a rundown part of town that's yet to be developed, and you can make an absolute killing if you buy there at the right prices. So, but in an area that's mature, like a nice suburb with nice schools, just a nice environment where people want to live, even during recessions, then you don't see prices come down too much. I remember in the 2008 crash in the suburb where I live, and I'm covering now for my new estate agency, prices didn't drop that much. Yeah, they dropped a bit, but it wasn't a massive crash because there were still people around with money who could buy, and the market sort of survived and recovered, if you like. But I don't think it was affected by that much. But lending did tighten up. It was quite difficult to buy stuff, and then interest rates came down, and that sort of revived the market again, I guess. And there were lots of quantitative easing. And quantitative easing started at that point, and of course then you saw inflation come in because they've been printing money on an industrial scale for the last 10 years, and now we're seeing inflation. They're blaming it on the war, but I don't think it is. I think it's because they've just printed too much money. But let's say the worst happens and prices did come down by 20%. Would that necessarily be disastrous? Well, you could take it one way or another. I mean, it might be disastrous if you're borrowed up to the hilt and you can't afford your mortgage, or you haven't got any tenants to pay your mortgage. But in reality, it would bring us back down to prices as they were in 2020 before so at that time, prices were okay, and then they shot up, didn't they? By even the last year, prices have gone up by 10%. So if they come down by 10% this year, we're not back to prices in the 1970s, are we? You're not going to be able to buy, a 3-bedroom house in a nice suburb for £30,000, are you? Things are going to come down, but not by stupid amounts, because the demand and the fundamentals are there. People need somewhere to live. There's not enough properties generally there's not enough properties. That doesn't mean it can't slow down, but there's certainly not enough properties. So I believe things will not be as bad as some people think. If you're in the stock market, however, that can just drop like a stone. So I wouldn't be exposing too much of my money in the stock market right now. Although, funds and that sort of thing, they can't just pull their money out because they've got billions of dollars and pounds in funds. They can't just sell all the shares because that would cause a market collapse. Now, actually, talking about auctions, that I mentioned this, that I'm opening up my own estate agency. We're going to be called Open House South Herts. That's HERTS, which is South Hertfordshire, covering sort of northwest London, Hertfordshire type of area. And I'll be opening later this month. Just waiting for some of the licenses to come through, and then I'll be running an estate agency. You might think, why would you go into this market, into a estate agency now in this market? Some people say, don't do it, But I think, even if there is a slowdown, the market will continue. People will still need somewhere to live. There might be less activity, but there will still be some activity. Now, what we're also doing is offering auction facilities. People who want to sell properties a little bit faster with a guarantee of, once you've sold, and it can't fall out of bed later on. And we're offering an auction facility where the seller, the person selling the property, traditionally they would be the one to pay the estate agent fees or the auctioneer fees. In this case, we're offering a service where the seller pays zero fees and the buyer covers the fees. It's a little bit different, but it works very well. And the auction is an online auction that continuously runs, a bit like eBay, I suppose, unlike an auction where there's fixed dates every month. Now, that's very interesting for people who want to sell properties fast. Now, the difference, I'm going to talk about this in my UK property talk on Saturday, but the difference between auctions and buying through a traditional estate agency is vastly different. First of all, if you're a buyer, you register, you give your details, you generally put down some sort of holding deposit to make sure you're not, just wasting time. And once you've bid on that property and your bid's been accepted, you have effectively exchanged contracts and you've got 28 days to complete. In general, right? That's the usual, 28 days to complete. And you're committed to buy at that point. Whereas if you walk into an estate agent and say, I want to buy that property, and they accept your offer, you can then mess around for months and months and months and then pull out. And so until you've exchanged contracts, which is where you've signed and you've agreed to buy it, you're not committed, and the seller also can pull out at any time. In an auction, as you might have seen in these shows, once the hammer goes down, that's it. The seller's committed to sell and you're committed to buy, and it's done and dusted. So some people like the idea of selling at auction because it's a guaranteed sale. It's not for everybody, and admittedly, most auction properties tend to be properties that are run down, need work, or got a sitting tenant, or got tenants in them, or they're commercials, or they're flats above, fish and chip shops, or properties with structural problems, all sorts of things. But you do get ordinary properties being sold through probate. They want a quick sale, or through housing associations that want to sell off stock. So there are genuine reasons why people sell in an auction. It doesn't mean that every property in an auction is a disaster. You've got to be careful. You've got to do all your homework beforehand, because when you bid on that auction, you're committed then. So it's no good afterwards saying, well, I've done a survey and I've found that there's rising damp in there. No, that's tough. You should have done your survey before you bid. So I'll be talking more about this on Saturday in my UK property talk at 10 o'clock. Now, if you want to get into property investing secrets and learn about property investing secrets, there's a free training on tonight, 7 p.m. Now, if you're watching a recording of this, you've missed it, but Wednesday, 1st of June, 7 p.m. There's a free course. It lasts for a couple of hours. It will give you lots of content on how to get into property, learning the secrets that experts have used to make a fortune and build up large portfolios in property. Don't just go out and buy anything without training. Now, this is free, so it's a no-brainer. Yes, it's a free training. It will give you lots of information. Then it will give you options to go deeper into certain areas. Like your favorite area might be buy and refurbish and flip. Your favorite area might be buy to let or or just deal packaging where you don't even have to buy the property. So you can learn about these things and maybe go into those things deeper and pay for a course, which will be a deeper course after that. So I'll put a link up to that. Click on the link. Nothing to lose, have you? I mean, it's a free course. You can either watch EastEnders tonight or Coronation Street, or you can learn how to make $1 million in property. Not everyone's going to make $1 million, but you can learn how to make a fortune and build a large portfolio in property. It's been good for me over the years, and I'm sure it'll be good for me again. I don't care what the market's doing. You know, if you're a property investor, you can make money when the property prices are going up, down, or sideways, because there are always strategies to make money in property. So thanks for listening. Click on that link if you want to learn more about property, and also join me if you can Saturday morning at 10 o'clock for UK Property Talk, where I'll be specifically talking about auctions in this episode. And just one final thing, I'm doing this a little bit early this week because of the Queen's Jubilee here in London, Queen's 70th anniversary. It's a Jubilee year, so there's big celebrations going on in London. Millions of people have poured into London, so it's all British flags out there, Union Jacks. It's very festive here in London, and we've got 2 days of a bank holiday, unusually on a Thursday and Friday, and then you've got the weekend. So a lot of people are celebrating this weekend. So I thought I'd get my podcast out early this week, and because many of you might be away or travelling. Chaos at the airports, unfortunately. Lots of people are trying to get away, and flights have been cancelled because they haven't got enough staff and that sort of thing. You know, we've still got this hangover from the lockdown from 2 years ago, and you know, the government stopped the economy then and wonders why it hasn't immediately bounced back. Well, there's still problems out there, and that's another thing that's slowing the growth, and why the UK slipped back into negative growth last month, and the US went into negative figures for the first quarter of 2022. Anyway, don't worry about all that. Happy Jubilee to the Queen and everybody there. Enjoy your day if you're out in London this weekend. It'll be hopefully be a lovely out down there. And it's great to see tourists coming back into the UK. So enjoy your time there, and don't forget to click on the free training tonight, 7 p.m. Click on the link and you can learn property investing secrets. I'll see you there. I'll be there as well. Join me tonight. I'm not running the course, by the way. It's someone else, but it's a really good course. Join me there, and I'll see you there, and I will also see you on Saturday morning, hopefully. Thanks for listening. Bye for now. This is Charles Kelly, Money Tips.